All right. So, hello, everyone, and welcome again to Decoding Capital, our weekly LinkedIn Live series where we break down what's happening right now in the world of private equity and private debt and make sense of mechanics behind the headlines. Here, Andrea Cosentino, like every week, in just 30 minutes, we walk you through the biggest news stories of the week, not just what happened, but also why it matters to you. Connecting the dots between market trends, practical advice for GPs, LPs, regulatory changes, and how this impacts you. If you're joining us live, feel free to drop your questions in the chat. I'll do my bring to best them into discussion. And of course, make sure you follow us on LinkedIn and Medium to keep up to date with the latest content. And speaking of Medium, let's jump in. For those who follow us on the Medium, of course, last week I published something around banking and M&As, and this session examines how PE is positioning itself in bank consolidations, carve-outs, and restructuring in 2025. And who better than someone with extensive banking experience as industry leaders to this day, having worked across the major banks and markets through global investment banks and major different asset classes. We have Vittorio De Pedys today with us with more 30 years experience in banking, a top investment bank. As I mentioned, today he serves as professor of finance at ICCREA Business School, University of Rome, and Pace University. Vittorio, you want to introduce yourself?
Thank you, Andrea, for the invitation. Let's not waste too much time on this. Just it's sufficient to say that it's useful to have this chat because it's an interesting moment. And I've been in this in financial markets for all my life, for like 30 odd years, on all sides, from the investing side, from the investment banking side, and as a CFO in a bank. So it's a space that has few secrets, but a lot of interesting things going on in this moment, like pretty much any time in this world.
And that sounds very promising and interesting. So, I mean, if we start, as always, from the top, right? We look at the banking M&A kind of ecosystem right now. It looks like there is a lot of activity going on. How has the regulatory and macroeconomic environment shifted in 2025 to make this banking consolidation attractive again? And what does this new age we're entering looks like? Is it kind of, scale at all costs? What do you see happening right now?
Well, two things are happening. Well, several trends behind which are at play. Scale at all costs, perhaps. That would be more true in Europe than in the US for regulatory reasons. Keep in mind that, for example, the regulatory burden in the US starts to be very cumbersome if you have more than you can, even through. And if they move upside above that threshold, then they are hit with a lot more undertakings to do. This we don't have that in Europe, but we have a much smaller market, not only in terms of fragmentation, but in terms of size. So there are trends going on, which I think are a tailwind for the consolidation and an increase in M&A activity in the banking space. And many of these things are going, in my opinion, to stay. I just want to mention a couple of things. One is the much higher level of equity tier one capital, especially in European banks, with respect to a crisis moment in 2008, 2000. And then a few years later. So the equity component is much higher. The market values are much higher, and this is also has an important consequence for the PE and valuation. So banks are starting to plug themselves out from the hole which they've been for a decade in terms of very low valuation, where the market was been, generally speaking, extremely negative on their capacity to create value. Actually, the market in many cases has been of the opinion that the banking sector will be destroying value in the future. You can see that from the price to book ratio that has been below unity, below one for a long time, especially around Europe. So high prices, high equity component, much higher return on equity, which finally starts to beat cost of capital across both sides of the Atlantic. Lower interest rate respect to the peak of a couple of years ago, and in some cases, like in a more soft regulation regarding acquisition. These are trends which, in my opinion, are going to stay. So the need to scale is there, the means are there, and we can discuss this briefly about what it means on both sides of the Atlantic. We need to keep in mind that Europe and US are two very, very different environments.
What are the differences that you see? I mean, of course, they have different size and I would say approach very much, but what is the main points that you would take away?
Well, two very important. One is scale, especially in the upper part. The size of US bank is, just to give you an idea, Goldman Sachs, which is not a bank, is an investment bank, so it doesn't have branches and all that. So it's just a pure investment bank. Has a market capitalization which is higher than the highest of the European banks, and no banks like HSBC or Santander or UniCredit. So in terms of scale, is a massive difference. I'll give you another hint: is JP Morgan, which is about 800 billions worth of market cap, and that's a classic bank plus in bank conglomerate. While I don't know, UniCredit is 125, so 7 times smaller. So, and this is the biggest ones we have in Europe. So scale is one, regulation is a second one, and in my opinion, a third one, which is of huge importance, is the philosophical approach of governments to this. We have two completely different situations on the different sides of the Atlantic. In the US, we have a rehaul of regulations, especially the head of within the Fed, one of the Fed governors, which has the responsibility for oversight on banks, is Michelle Bowman. I personally think I think she will be the next Fed chair. It might not be, because Trump has got about 11 candidates, but that's my candidate. Now, Michelle Bowman is a much more laissez-faire type of regulator, and she wants to overhaul and change in a radical way the body of evidence that has been basically weighing on the US consolidation market in the bank space for all the Biden administration period. So I'll give you a hint. I've got a little data here to justify this. 5 years ago, there was, so before the Biden time, there was one deal per day in M&A in banking, while now there's starting to be 2 per week. And we had only 78 mergers in the first half of 2025. So what I'm saying is that the regulatory burden was so interpreted in such a heavy way that few deals have actually been done in the US. And this is going to change, though, with the Trump administration and Michelle Bowman at the helm of the regulatory branch. This means that I think we're going to see an acceleration of deals, especially in the medium to small size in the US. In Europe, we have a completely different situation, because on one hand, everybody's in favor of the banking union and consolidation. In practical terms, all the biggest deals of 2024 and 2025 have been basically blocked by activity of governments. This is very peculiar, because everybody pays lip service, especially governments, to the fact that we need to have a much more unified capital market union. But then I can mention 3 or 4 deals, if you want, in all of which are under scrutiny or basically blocked by government intervention, which clearly is at odds with the idea of a unified financial market union.
No, I mean that absolutely. That's definitely insightful. First of all, especially in your bet on the next Fed chair. But I just want to focus on this part now that you mentioned, right, about the regulation. So, and this is maybe a sense that I had, and I might be wrong, so please expand on that. But coming from that regulatory kind of roadblock, let's say, right, it looks like now regulators are trying to encourage a little bit more, though, private equity involvement as a sort of lender of last resort, let's say, providing transitional capital, which then takes me to ask you, isn't that what we see that private equity are focusing more on non-core carve-outs rather than full acquisitions, and they're kind of, from being those guys that used to come in and extract, now are becoming a bit of, heroes that want to save the days, or at least they're seen like that from the regulator, or you think it's still not the case?
Yeah, I agree with you. European Central Bank, which is on one hand, and I'm happy with this um, uh, international deals. And this is a very positive thing on one hand, because they're not increasing requirement and capital needs for cross-border acquisitions in the banking sector. So that it's a very, very interesting thing. I also want to say something about the fact that governments, again, on one hand, especially in Europe here, they've been basically blocking some of the important deals. On the other hand, in the last few years, they've been putting back to private some of the banks that believed and bought during crisis time. I can mention a few examples like NatWest, like Commerzbank itself, ABN AMRO, or even Monte dei Paschi in Italy. All these banks which have been acquired by governments and saved basically are now have been put back on the market or in the process of. So there is a bit of a contradiction going on there. Moving to the PE sector that you mentioned, which is extremely interesting. Okay, I would agree with you about what you said. There is an inroad, a massive inroad into the banking area by PE, and they are focusing on what I think you called non-core assets, and I think that's an interesting thing. Just to give you an idea, PE, some PE trends going on at the moment. The first one is that there is pent-up demand, because not all the deals that wanted to be done have been done. There is an overflow of necessity for exits, because funds have been buying and need to return some capital to investors, especially to LPs, which is not always easy. Okay, at the same time, there is a huge amount of dry powder. You know exactly what it means, so I will not expand on that. But the fact that there is all this dry powder drives activity in many different areas. There is this development of private credit, which is pretty new and huge thing, which in my opinion is worrying central banks in a massive way, scaring the daylights out of regulators, because they are not under their control. And if we're going to have rate cuts, which we don't know, but I would imagine yes, in both sides of the Atlantic, again, that's going to be helpful for the activity as well. The areas which are much more inclined to benefit from this are, in my opinion, tech, oil and gas, and life sciences, but also banks that we discussed today. It looks like that you are on the spot when you said that PE activity is increasing here, because we've seen an increase in private equity activity in 2025 by 16%, while at the same time, corporate M&A is only up by 8%. So private equity is basically doubling up in terms of activity into this space. Now, what are they buying? Are they buying banks? They're not. As you mentioned, they're buying what we can discuss like non-core assets. They're very interested into that kind of carve-outs. Okay, I wouldn't go as far as you mentioned in our conversation. I wouldn't go as far to say that central banks are happy that private equity is getting so much involved into banking, because I think it's a double-edged sword, and regulators are very much aware of the fact that in these assets, the activity of private equity is, as I said, is a double-edged sword, because on one hand, regulators, especially central banks, are super happy that banks clean up their balance sheet and concentrate their equity on what in principle should be controlled, which are non-core, is a very welcome development from the central banks. On the other hand, because central banks are central banks, they also keep an eye on the systemic global risk of the financial ecosystem, because that risk is just being transferred from a regulated entity to a non-regulated entity. So in terms of global risk, it's not going to diminish. It's just being shifted from one player to another player.
And, talking about risk, right? One of the things that comes up to my mind is, of course, if I think of how let's think about acquisitions, right? We acquire a part of a bank. As we said, we carve out just a specific session. And as a private equity fund, of course, the way a bank kind of restructures usually has a kind of longer cycle compared to a normal business. If we compare it, maybe it can take, let's say, up to 7 years. Whilst usually the fund length is about 10 years. So do you think this is going to bring also a risk from a private equity perspective, where they have an integration drag risk, which essentially requires private equity to be more patient when they interact with banks and banking deals? And so it's kind of changing their playbooks, their model, or you think that doesn't have an impact?
No, I don't think so. I think that what happens is that some of these assets that are being taken out from banks' balance sheet into private equity are risky. Not necessarily all of them, not dramatically risky, but they are risky. So managing, and I can also say that although paradoxical it can be, some of these funds are better at managing some of these assets than banks themselves. Banks, generally speaking, have never done a particularly good job in managing, for example, non-performing loans. Non-performing loans are subject to a very long cycle, as you mentioned. It takes you normally 10 years to recover potential losses. There is something going on, for example, on the balance sheet of European banks, which is pretty peculiar, which is the fact that non-performing exposure is now basically average across all European countries. So countries which had bigger problems, like Southern European countries, for example, where they had higher percentages of non-performing exposure on their books, are now basically back to same level as Nordic countries. So that's a very well. On the other hand, there is an increase within that smaller amount of non-performing exposure. There is a higher percentage of what we call the unlikely to pay. So that means that banks have to do a better job in the future. And, unlikely to pay are loans of, assets of some kind, which are not in trouble, but they look like they're going to get in trouble at some point. Okay. So they're not a clear non-performing situation, but they might reasonably evolve into something like that. So the fact that this is increasing, in my opinion, requires from the bank some skills that I'm not sure they are completely equipped with, which means helping troublesome situation not to become non-performing. Okay, so let's see how it goes. So far, private equity has been extremely instrumental by taking away the non-performing exposures from the bank's balance sheet. That's why the bank's balance sheets are now so much more healthier than they used to be 5 or 10 years ago. So this integration is just making the ecosystem more complex. It remains to be seen whether private equity GPs have the skills, which most likely they do have, to manage this kind of credit exposure or other kind of non-core assets. It's not just non-performing loans. It can be a group of branches in some areas. It can be fintech. It can be insurance pieces. So that's a pretty interesting development going on right now.
And just to, of course, in the interest of time, as we said, our sessions are about 30 minutes. So I just want to kind of tie together two questions as a wrap up, which, kind of come as a forward-looking, if that makes sense. So, of course, the first one is whether this current M&A trend that we see, is it sustainable, or is something that is just cyclical and we will see an end soon or not soon, but, kind of, it's just temporary situation driven by market conditions. But also, whilst we go through this, if it is a cycle, how do regulators can balance then the stability that they need in banking with the efficiency that is brought by PE into the system, which usually, as we said extensively, they comes with a risk. So say again, just to summarize it, is this going to continue? And if it continues, whilst it continues, what the regulator would do to just keep it balanced?
Yeah, it's a very interesting. Well, the second question is very interesting, and I don't have a complete answer in terms of we should be asking the regulators. I think that they are scared by these developments. They are ready to contribute to the regulation of the ecosystem. So the problem is for the central banks is they tend to have jurisdiction only on the banking system, and now so much of competition of the banks comes from non-banks. Think of all the developments of those quasi banks that offer services like buy now, pay later, which are a scheme for most likely getting in trouble at some point in the future, and they're not regulated. Or think about if you want to talk about it, the competition by brokers or banks like Revolut or others, which absorb a huge amount of interest, especially from younger generations, and they are much more difficult to control. So, and these are, in my opinion, are like private equity funds, if you want to assimilate to in the way they do, with smaller capital and very high pressure on returning capital to shareholders, to investors, excuse me. So from the second point, the second question you asked about this is, I think regulators are in deep trouble because basically they excuse me, have jurisdiction on half the world, but they are kept or taken responsible for the whole activity in the financial system. So I would say that regulators need to evolve very quickly. They are, but not necessarily quickly. We have one added problem that we have in Europe respect to the US is that we still have national jurisdictions, and the banking union is not complete. Just to mention, we do not have harmonization of insurance on deposits or resolution crisis because the MES has not been completely ratified. We don't have a common definition of financial markets and insurance. So we need, as Europeans in this group here, the Europeans in this group, we need to accelerate as much as possible in the creation of a level playing ground, even without talking about taxation and fiscal policy harmonization, that it's even more difficult. But just staying on the technicalities of financial markets, we need, and I think the European Commission is starting to do a great job on this one, but we need to accelerate. The fact that we don't have just a banking union, but we must have a capital markets union, an investment union for protection of investors all over Europe, okay, without increasing the amount of administrative regulation, but leveling the playing field, which is not there at the moment. As for the first question about what's going to happen in terms of trends, I think this trend in increased activity in M&A in the banking sector can only go on. I have a few ideas about this. First of all, you need for scale. There is a lot of banks, and we need to scale. Why do we need to scale? It's obvious. Okay. Just the investment in IT of JP Morgan. Let me give you data. Just the current investment of 18 billion, which is bigger than the budget of NASA. Just the pure investment of IT of giant like JP Morgan. So these are costs that need scale, plus competition, as I mentioned, from non-banks. Okay, so for this need, and there is also, so how do banks react to this? Increasing scale and increasing diversification from pure interest rate play. These things can be done, and actually they are favored at the moment by the fact that, as I mentioned, banks' balance sheets are healthy. Return on equity is pretty high, in the region of between 9 and 11% on both sides of the Atlantic, so it covers cost of capital. Shareholders are much more happy now than they used to be. Ratios are price earning and price to books are starting to move up in a reasonable way. Market capitalization are much higher than been in the past. Oh, by the way, talking about PE, if you give me a second, I want to mention a fact that I find interesting, and it is that in basically all the biggest deals which have been going on in 24 and 25 between banks, acquisition in the banking sector, 90% of them have been proposed by as a currency with paper. So stock exchange rather than cash. So why is that happening? I think that's happening for a number of reasons. And one of the reasons is that the main one is that the evaluations of the acquiring companies, banks, are now substantially higher than they've been in the last decade. So when you're a CEO of a company which has a very high stock price, the first thing you think about is how can I use that overvaluation in order to acquire real assets in exchange for my perhaps inflated stock price. So that doesn't surprise me that much. In Europe, we also have another situation. So we have excess capital in most of the top tier banks. So that's another reason why. For example, I did a valuation of UniCredit some time ago in my blog, and I put up a target price at 73 when the stock was trading at 50, because I did a calculation of how much excess capital was sitting on those books if it was not used for M&A, which they were trying to do, but if they couldn't be used for that reason, that money would be returned to shareholders, so increasing shareholder value. That's one of the pieces of my calculation. Plus, you have to remember that we have something called the Danish Compromise in Europe, which is this facility that banks have now after they've been voted positively by the European Central Bank and the insurance body, that if you have an insurance company within your perimeter, this decreases actually the amount of capital you need because it's act as a counterbalance to cyclicality. So that's why lots of banks are looking into the insurance space in order to do acquisition there, because it actually optimize their capital base. So all these things. Plus, let me add one more thing, which is that the shape of the yield curve. So banks have been making a ton of money on the net interest income, so the spread, interest rate between lending and borrowing, since, especially in the US, since when the curve started to become positive, which has not been for many, many years, and it is now. So when you have the more this preserved, because banks fund at short term and invest long term. So that's an interesting point. And to finish on this, on the perspectives, there is a lot of consolidation material. If you let me give you just numbers, but if you forget about Japan, which has few banks, the country which has the smallest amount of banks in Europe is Spain with 180. But then you've got France 380, Germany 1,280, 1,280, Italy 420, 500 banks. Of course, US is much bigger market, 10 times bigger, but still, so there is a lot of space for potential consolidation. And what I would like to see is that governments stop interfering with market forces. This is true for Europe, because we have all these potential interesting activities going on in M&A, which have been basically blocked by government intervention. And it's time for us Europeans to decide if we want a market economy with all the goods and bads of it, or if we want to run it like in a more centrally planned way, which is, in my opinion, is never going to be a better allocator of resources the market. So I'll leave you with that.
Nice. Vittorio, thank you so much. Honestly, this is like, as always, extremely insightful. I mean, I've known you for years and I knew this was going to be an interesting one. So I hope, a lot of people got connected. Unfortunately, we don't have questions for now, but also because I think you've been very explanatory. So that's good. Of course, the session is recorded, so we're going to repost it in the next days. Thank you so much. Definitely we'll keep an eye on the M&A in banking. And thank you everyone for joining us today. And we look forward to see you next week on Wednesday, same time. Stay tuned. Have a nice evening, everyone. Bye-bye.